Okay, so we're going to continue where we left off, right? So in the first two scenarios, ABC company purchased 30 widgets, 20 widgets, 10 widgets that is going to sell to XYZ, but on January 1st, it didn't sell anything, right? So there's 20 widgets, 30 widgets. Each widget cost ABC $100. So the cost per widget is $100. We went ahead and we put this into the T account. So my inventory now is $3,000. My accounts payable is 1,000. All right. So now ABC now sells how many widgets? 5 widgets to XYZ company for a total price for $150 each. The terms of the sale are 1, 10, and 30, and you'll remember that. You may need to go back and look. 110 means you get a 1% discount if you pay within 10 days, otherwise the full amount is due within 30 days. So when you see this, right away you should do a quick calculation. This is the 5th, plus 10 is the 15th. They're going to pay before the 15th, so they're going to take the discount, and that's our scenario, right? Sale on credit with discount taken. And FOB shipping point, who pays the shipping cost on FOB shipping point? Well, if you go back, FOB shipping point, who pays? The buyer pays the shipping cost, and the freight is going to be freight in, and it's going to be part of inventory. Okay, so we know that. All right. So one of the things, this is a really can be a confusing entry for most people. So you may want to slow down here and make sure you understand this, right? So remember, you're the seller and you're engaging in a sale. So there's two things that happen. So first is you're going to take some stuff out of inventory and you're going to sell it. And you'll remember here what happens to items that comes out of inventory. It comes out of inventory, it goes to cost of goods sold when you sell. So right now the items are sitting in inventory, it goes to cost of goods sold, and this has to be at cost. The same cost you used in inventory is the same cost number that you need to use in cost of goods sold, okay? That inventory and cost of goods sold is always at the cost. Now remember, cost is not the same thing as selling price. It cost ABC $100 per widget for these items, right? Well, it's going to sell these for $150. So the selling price and the cost are two different things, and you have to keep them separate, okay? So we know that this is going to come out of inventory. When we go into inventory, we debit inventory. When we pull it out of inventory, we're going to credit inventory. So we're going to credit inventory for $500. How did I get $500? Well, it's 5 widgets. The cost per widget is 100. 100 times 5 is 500, right? I'm pulling $500 out of inventory, okay? And where am I putting it? I'm putting it into cost of goods sold. So how do I put something into cost of goods sold? I debit cost of goods sold. That's the journal entry for this part here. You credit inventory to take it out of inventory. You debit cost of goods sold to put it into cost of goods sold. So that's what happens. And again, these are all at my cost. Okay? Now, did I sell it for cost? No, I did not. How much did I sell this for? I sold each widget for $150. So if I take 150 times 5, that's going to give me $750. So what do I do with that? Do I just inventory for $750? No, it's a big no, the answer to that question. Inventory, cost of goods sold are always at cost. Our cost is $500. So I had a sale of 5 widgets times 150, which is $750. So I'm going to credit sales revenue because I made a sale for $750. Did I get cash here? I did not get cash. My customer owes me money for this sale. So what do I debit? I debit accounts receivable for $750. And this really trips people up. When a seller engages in an entry, you have 2 parts. First is the part that's going to take the items out of inventory and put it into cost of goods sold. That's this first part, right? And that is always at the cost, the seller's cost. Now, the next part is going to be the actual sales part, right? Because in the income statement, you have sales and then you have cost of goods sold. So you're going to debit accounts receivable for the selling price and credit sales revenue for the selling price, all right? So when I go over here to the seller, I am going to put $500 as my credit to inventory. Okay, so notice what happens, right? When I put in the $500, it's 3,000 now. I put in the $500, now my inventory goes down by 2,500, right? Which is what I expect. My cost of goods sold goes up by 500 because this represents what I sold. So these two mirror each other. Now I come over to accounts receivable and sales revenue. Accounts receivable, I'm not using the cost, I'm using my selling price, which is $750 because this is what the customer owes me. And over here for sales, I have $750 on the credit side. Okay, so it's two parts, two-part entry. The inventory and cost of goods sold, which deals with the cost, and then sales revenue and accounts receivable, which deals with the selling price. Now, what is XYZ going to do? XYZ now what? XYZ purchased these items. Did XYZ purchase these items for $500? They did not purchase it for $500 because they purchased it from who? ABC for how much? $750. So anyway, XYZ is purchasing these items, right, from ABC. So how much is XYZ going to purchase it for? It's going to purchase it for $750. So you will see the selling price for ABC becomes the cost price for XYZ. So the inventory cost price for XYZ is actually the selling price for ABC, and that makes sense, and this happens all the time. My cost is someone else's sales. Someone's sale is my cost, right? My accounts payable is someone else's receivable. Someone's receivable is my accounts payable, okay? So now I'm going to, XYZ is going to debit inventory, but not for 500, for 750 because the cost for XYZ is 750, okay? And now I'm going to have here, right, what is going to be my credit? This was purchased on credit, so I'm going to credit accounts payable. Now look at what happens here. The accounts receivable for ABC is the accounts payable for XYZ, right? The inventory that I purchased is the revenue that was sold for ABC. So these two mirror each other. The sales and accounts receivable mirror the inventory and accounts payable for XYZ company, and it should because XYZ is purchasing not at the cost but at the selling price, okay? So now I'm going to go over to XYZ and I'm going to put in $750 for my inventory, right? And then my accounts payable is going to be $750, okay? And again, the accounts payable for XYZ is the accounts receivable for ABC, right? And the inventory here is the sale, okay? Does that make sense? All right. So again, right, there's 5 items at 150, so just make sure you track that and understand that.